Hello, I'm Noel Lim on ASEAN Speaks by Maybank. Singapore's final third quarter GDP growth came in lower than advanced estimates due to a downgrade in manufacturing, mainly in the electronics cluster. Meanwhile, Thailand's GDP growth of the same quarter accelerated to the fastest pace in 5 quarters, supported by tourism recovery and strong rebound in private consumption. Suhaimi Ilias, chief economist, discusses with our analysts on their latest research reports.
Hi, morning everyone. We are one day late than our usual Monday call, courtesy of the public holiday yesterday declared by the newly minted Prime Minister Anwar Ibrahim, who was sworn in on Thursday last week on the back of strong, formidable and convincing majority from a unity government post-election. Back to the usual quick roundup of key developments last week. Equity markets were generally positive, mainly on indications that the Federal Reserve is slowing its pace of rate hikes as per minutes of the 2nd November FOMC meeting. But the overall message from the major central banks, i.e. Fed, ECB, Bank of England, are that interest rates still need to be raised further, albeit at slower pace than the recent rounds of 75 basis point hikes. These are signaling higher terminal interest rates. In the bond market, yields of longer maturity US Treasury decreased more than shorter maturities, leading to further and deeper inversion of the yield curves. Signals of economic downturns are also seen from flash November composite PMI for US, Eurozone and UK, all of which are below 50 for the past 4 to 5 months, signaling weakness or contractions in manufacturing and services activities. In China, rolling lockdowns are causing tension and protests among the affected people, as well as raising concerns about economic outlook. Several cities in China impose broad restrictions on movement and introduce mass testing as daily coronavirus cases approach all-time highs. These include 8 districts in Zhengzhou, home to Apple's largest iPhone manufacturing site. China's authorities stepped in to support growth. PBOC announced a 25 basis point cut to the reserve requirement ratio, or RRR, for banks on Friday. And many of China's large state banks have agreed to boost lending to real estate developers following government's announcement of a property sector support package earlier. This morning, we have Hak Bin, Joey and Dr. Zamros to talk about macro, followed by Winson on fixed income market outlook, Anand on ASEAN Equity, and Andi on FX. Now let's start with Hak Bin. Plenty of stuffs out last week on Singapore macro, slower final third quarter GDP numbers, decline in October industrial production, easing in the October's headline and core inflation. Can you run through with us these statistics? And I think the key question really is, what are the implications to Singapore's macro outlook, as well as where do you think or what do you think Monetary Authority of Singapore going to do with regards to their policies?
Yeah, morning, Suhaimi. Morning, everyone. So I think 3 takeaways. As you said, there was a barrage of data last week. One is manufacturing actually contracted for the first time in 13 months. That's weighed down by a steep decline in pharma and chemicals. But I think electronics continue to contract, and there's a sense that the slowdown is broadening. At the same time, Nordex as well is in contraction, minus 5.6%. That's also the first contraction in 2 years. So I think clearly we're seeing a slowdown in external demand, and that's going to hit the export and manufacturing side. So on that, the government came out as well with their forecast for next year. So this year, they've fine-tuned it to roughly about 3.5%, in line with our growth estimate. Next year, it's a bit more gloomy. They're looking at half to 2.5%. Our forecast is 1.5%, so right in the middle. And I think this basically allows for the possibility of a shallow recession, possibly 1 or 2 quarters. In our models, the probability of recession in Singapore has risen to about 16%, and for the US, it's risen to about 35%. So that's pretty high. We think what will likely emerge is a two-sided economy, one where actually manufacturing and some trade-related services could contract. But on the flip side, there will be the reopening sectors, the consumer-facing sectors that might still be growing at a healthy clip. Aviation, hospitality, F&B, in construction as the workers come back. So with some of this tailwinds, I think still having an impact, the recession, if it materializes, could be somewhat shallow. The third point is the good news last week as well was the inflation data. It looks to have peaked. It has come off in October. So I think we're expecting it to come off slightly, but it may be somewhat sticky. So even though the inflation may have peaked, I think the MAS is sticking to the inflation forecast. Some of the concerns is actually on wage cost pressures in the labor market, which I think still remains pretty tight. There's still lots of stories about worker shortages in areas like healthcare or F&B, construction. So we are still penciling the MAS to tighten again in April, but probably via a recentering of the band.
Thanks, Habin. Juye, on Indonesia, the government announced a maximum 10% minimum wage hike for next year. I think first question to you is, how is the figure determined? Is it a formula or is it a consensus figure reached between the government, employers, and workers?
Morning, Suhaimi. Morning, everyone. So for Indonesia, the adjustment in the minimum wage is actually determined by a formula. It takes into account several factors, including inflation, economic growth, as well as the productivity of each province. The 10% hike is actually below labor unions' demand for at least a 13 to 25% increase because of the jump in inflation in recent months. In fact, the deadline for provinces to announce the minimum wage change was yesterday, and most provinces decided to hike by less than 10%. For instance, Jakarta announced a 5.6% increase, Central Java by 8%, so the average change nationwide seems to be 7.2%. We think that the net impact of a minimum wage hike on the economy will likely be muted. Following 2 years of very small increases, 0.5% in 2021 and 1.1% in 2022, the 10% hike for next year is actually in line with the surge in average monthly wages, which rose by 12% in August because of rising living costs as well as the economic recovery. The wage hike will help to boost purchasing power among the low-income group and cushion the impact of the 30% fuel price increase effective September. We are maintaining our GDP growth forecast at 5.1% in 2023, unemployment rate forecast at 5.3% as well, on the back of a continued economic recovery. The firm FDI momentum we have seen in the past 2 years, especially in the primary and secondary sectors, will help to provide more job opportunities. And we are also keeping our inflation forecast at 4.6% for next year, as the rise in labor costs for firms are offset by easing costs of energy and raw materials. Back to you, Simon.
So with this view of muted impact of the minimum wage hike on key macro variables like growth, inflation, unemployment, investment, what's your thought on Bank Indonesia's monetary policy?
So for BI, we are maintaining our view that they are going to continue hiking by 75 bps next year. So that by 50 bps next year. So that would bring 2023 the terminal policy rate forecast to around 6%, compared to the 5.5% expected by end of this year.
On Thailand, the quarter GDP picked up pace, but the reality is growth is trailing ASEAN 6 peers. What are the drivers of growth last quarter, and why Thailand is still lagging in this economic reopening recovery story, how do you see the economy performing next 12 months?
Yeah, so third quarter growth actually came in above our expectations at 4.5%. That was boosted by the jump in services exports on the back of a tourism rebound, as well as the strong rebound in private consumption and private investment from last year's low base. This helped to offset the decline in public consumption, as well as the wider deficit in net exports. But we are maintaining our forecast for 2022 at 3.2%, but we cut our 2023 forecast to 3.5% from the previous 3.8% on the back of slowing goods exports as global recessionary risks rise. Yesterday, Thailand announced data for October trade, and it showed exports declining for the first time by 4.4% since February last year. And the weakness has broadened from China to other major markets like the US, EU, and even the ASEAN 5. We think that the continued recovery in tourism will drive growth next year, while domestic demand will remain in expansion, but likely at a slower pace than what we saw this year as the reopening tailwind fades. As for BOT, which is meeting tomorrow, we are looking at a third hike by 25 bips to 1.25%. The central bank's assistant governor recently stated that BOT is going to stick with its gradual approach to monetary policy tightening. And he added that the baht seems to be at an acceptable level following the 7% rally this month.
On BOT monetary policy, is there any further hikes expected after tomorrow's expectation of 25 bips increase?
Yep. So for Thailand, we are penciling in another 25 bips hike in 2023. That will bring the terminal policy rate in this cycle to 1.5%. So we think there is one more hike due in the first quarter of next year, after which BOT will likely pause because of the slowdown in major economies and also the impact of that on its exports numbers.
All right, thanks. Zamros, Malaysia's inflation for October showed headline inflation peak, but core inflation is still creeping higher. Why is this? And what is your expectations on the policies and measures to deal with inflation under Prime Minister Anwar Ibrahim's government, and how it affects your forecast or views on Malaysia's inflation outlook?
Hi, morning, Suhaimi. Morning, everyone. Inflation for Malaysia in October was down, easing further to 4% year on year, from 4.5% year on year in September. So this is significantly lower than the 4.7% year on year printed in August this year, which we think that the August inflation was the peak for the cycle. So the easing continues mainly on the slower rise in housing, water, electricity, and gas and other fuel, which was down to 1.5% year on year from September of 4.5%, mainly due to the base effect, as the 3 months electricity discounts under the Pemulih scheme ended in September 2021 last year. Rightly so, the core inflation continued to edge up to 4.1% year on year in October from 4%, which makes for the first 10 months, core inflation stood at 2.8%, significantly higher than 0.7% for the whole of last year, mainly because of the pent-up discretionary spending and services demand effect of economic reopening. And also with the GDP growth was sizzling 14.2% year on year in the third quarter. We estimate that the output gap to already been positive in the third quarter. So with that, we expect core inflation to remain elevated for the next few months. We are keeping our inflation forecast for this year at 3.3%. But I just revised downward our forecast for next year to 3% from 4% previously, mainly because of the 4% forecast that we put up previously assumed gradual adjustment in fuel prices and electricity tariff on subsidy reviews in early 2023. But the newly appointed Prime Minister Anwar Ibrahim had a meeting with the National Action Council on cost of living on Sunday, and the council was given 2 weeks to come up with a proposal on targeted subsidies and their implications. So pending clarity on this, we are revising down our forecast to 3%, but we may need to adjust our forecast again once we got the clarity on the subsidies proposal by the government. Suhaimi.
Yeah, thank you, Zamros. Let's move on to fixed income market. Winson, after 2 years of losses, do you see 2023 to be a better year for Malaysia's and US bond markets, especially in relation to macro prospects as well as monetary and fiscal policy outlooks? Where do you see the 10-year MGS and US Treasury yields to be next year?
Hi, morning, Suhaimi. Yeah, it has been a tough year for most asset classes. Equities, bonds, credits are all down. And if you look at the bond total return in local currency, Malaysia year to date is down by 0.7%. It's much better than the US Treasury, which is down by 12.3%. But still, it's quite a challenging year. But looking ahead, we expect a brighter year ahead for government bonds. For Malaysia, we are forecasting a strong 6 to 8% total return in 2023 compared to the average of 4 to 4.5% due to a couple of reasons. The first is interest rate. BNM may hike rate by another 25 bps to 3%, but we think the OPR cycle has already reached the late stage. And from a valuation standpoint, the 3-year MGS yield is giving a sufficiently wide spread compared to the OPR. The spread is more than 100 bips. I think this has priced in for another 3 rate hikes compared to our view of another one. And second, if you look at the supply and demand technical, supply is still high because the government fiscal consolidation falls short. But we think the demand for bonds from especially the major investors like pension funds and banks will continue to be healthy. So I think in short, having long MGS and GI duration exposure at this stage of the economic cycle is key because the global rates and dynamics may unexpectedly deteriorate from late cycle into end of cycle pricing. So ahead, moving away from Malaysia and into the US, it has been an extremely volatile year for US Treasury, but we expect yields to fall over the next 6 to 12 months because if the Fed indeed hike rate to 5%, it will be the most forceful tightening cycle since the 1980s. No doubt, the US labor market is still very tight and inflation is unacceptably high. So the Fed is very hawkish and the near-term over-tightening risk, I think, is high. But if we look at the leading economic indicators, they are pointing to a US recession in 2023. The housing market has been deteriorating. For example, the manufacturing new orders, consumer sentiment survey, they're all weak. And the yield curve inversion, doesn't matter which part of the curve, the key curve we look at, the 210 is deeply inverted. The 3-month 10-year also inverted since last month. And there's another curve, it's called the Fed preferred curve, which is simply a difference between 3-month Treasury spot and 18-month forward. And this part of the curve also inverted.
Winson, just to repeat one question I asked earlier, where do you see 10-year MGS and US Treasury yields next year?
Our forecast is by the end of first half next year, 10-year US yield 3.25% and 10-year MGS 3.9%.
And what would be the upside and downside risk to your views on markets and yields?
The risk to our view for lower bond yield, I would say, is upside surprise to the terminal Fed funds rate. Because yes, the Fed, we do believe they are going to slow the pace of hike to 50 bp coming to the December FOMC. But a continuation of 25 or even 50 bp of hike for an extended period can still cause significant upside risk.
And by the way, have there been any comments made by the international rating agencies on Malaysia's rating outlook since the election?
Since the election, there's been no major comments from the rating agencies, S&P, Moody's, or Fitch, even though there's been separate comments by some of the subsidiary, not the rating agency themselves, but by, for example, Fitch Solution, commenting short-term political risk in Malaysia is higher, which I think is understandable. But so far, we have not seen making any rating changes or outlook changes on Malaysia rating. All agency, S&P, Moody's, and Fitch still carry a stable outlook for Malaysia rating.
All right, thanks, Winson. Moving on to equity, Anand, on ASEAN equity, there's really a lot happening on macro, on policy and politics that's obviously affecting the market. I think I just have a simple request to you. Can help our listeners this morning navigate through all this in terms of what to do with their money and portfolio.
Yeah. Hi, morning, guys. Morning, Suhaimi. So that's quite a big question. I mean, when you look at how markets have been performing in the last couple of weeks, they have been very resilient. Yeah, and they have been reflecting sort of an improved sentiment on global markets as well. The sense that interest rate increases may be less dramatic going forward, even though in the ASEAN context, we still do expect some further rate hikes into 2023, as the previous speakers have mentioned. But overall, investors looking at 3Q results, which have been fairly resilient, no major corporate blowups in the region, and the fact that economic deceleration next year very much baked into valuations right now. Just to remind investors, ASEAN markets are not expensive. Most of them are -1 standard deviation versus mean. Something like Vietnam is more than -2 standard deviation versus mean right now. So a lot of potential downside is already factored in terms of macro issues. So I think, to answer your question, the markets are taking macro changes, policy changes in their stride, and where there's sort of indications that things are improving, even on the political front, like Malaysia. We saw a big positive move on the market last week in response to that. So I think overall, investors should remain very much invested in the ASEAN space. I think the biggest risk for us going to 2023 is actually external, in particular capital flows. Yeah, because now for the last 2 years, ASEAN has benefited to a large extent, not just from stable macro, stable policies, a very defensive mindset, but also from the fact that nowhere else in the region looks particularly safe for investors, especially North Asia. But what's changing right now is that there's some sense that China has found the bottom, and perhaps it's time to reallocate capital towards North Asia. So I think that is something that is a bigger risk to market performance in ASEAN as compared to macro or policy issues.
In that context, as far as ASEAN equities is concerned, what would be sort of the preferred sectors across the region that investors should kind of position themselves?
Yeah, so a couple of things. As we can see from very strong 3Q GDP performance, the recovery from the pandemic years, the rebound of economic reopening, still the momentum there is still quite strong, and we are seeing consumer stocks in particular reflecting that rebound. So we continue to ask investors to be weighted in consumer stocks across the region, especially Philippines, Indonesia. You have some very good picks there. In the Philippines this time around, we upgraded Monde to buy as well. So that's something that you could look at. The other sector that we like is financial still. And we are still talking about interest rate rises into 2023. And credit costs have been relatively well behaved across the region, except perhaps a little bit in Thailand for the finance companies. So I think financials is another sector. Consumer and financials will be the two where we are quite comfortable still to be invested. The third one, the final one to keep an eye on is obviously tech. A lot of value now in ASEAN tech after the global sell-off, which has not spared ASEAN plays. And we're starting to see value emerge there again. So this time around, we upgraded Great Tech in Malaysia to buy. So that's something that we would keep an eye on in terms of sector allocations.
Thanks, Anand. Andy, looks like FX research called that dollar gains would lose momentum later this year and into next year, kind of materializing. But do you think this is really the beginning of the end for US dollar? Do you think regional currencies will experience the situation of rising tide lifts all boats, or will there be material or nuance differences in their performance versus the greenbacks, and why so?
Hi, morning, Suhaimi. Indeed, I think there's going to be slight difference or relative differences between currencies, but on a broad dollar view, I think we are still in some, not say early days, but still remain cautious in terms of the dollar weakness being enhanced a bit further. So like you mentioned, the momentum has slowed down. Our view is, I think the central case is that the US economy slows, but gradual cooling in inflation through 2023 and avoids a recession. But what we are concerned about would be that the risks on both sides of the central path, which is not very well priced, which is actually more inflation persistence, and I think outright US recession might come on stream. So two big uncertainties still on the dollar front, whether inflation will slow sufficiently and whether the US economy can avoid recession in the process. And that remains a concern. So on the dollar front, we think there could still be some room for at least about 2 to 3% appreciation in the dollar until probably in the first quarter of next year. So that would nicely mean that dollar Asians could still see a bit of a resurgence slightly into first quarter of next year, or remain flat into end of this year, or slight resurgence as well into end of this year. And then eventually lose momentum. So for example, if you look at the ringgit, we are looking at ringgit moving towards 450 to 455 by first quarter of next year, before falling down towards, before ringgit strengthens back towards 420 levels by end of next year. So that's one example of the trajectory that we expect to see on the dollar front. On the dollar front, I think it's still a bit tricky in terms of your question about whether dollar peaks. Typically in the past, when dollar weakens, it typically coincides with troughs in activity on the US front, equity strength, and also an easing sort of Fed sort of environment. But I think we are likely to see those conditions materialize for this next few quarters, which lends credence to why we think a dollar will continue to be supported mildly into first quarter of next year, Suhaimi. So at some point in early 2023 or sometime in the middle of 2023, we could see a confluence of these factors materializing and sort of lead to dollar sort of momentum winning consistently, sustainably into end of next year. Suhaimi?
You kind of mentioned in passing about ringgit, so I'm going to press you a bit on that, because obviously there's a lot of interest on ringgit outlook post-election, and I think our pre-election outlook for ringgit is a ringgit ending this year at 480, but improving 450 by end of next year. So with what has happened over the past 1 week plus, can you share with us your thoughts on that now?
Yeah, so that your valid question. Our view quickly is, I think we remain cautious in the sense whether the levels below 450 remain sustainable. Like I mentioned on the dollar front, we still think there could be at least 2 to 3% appreciation, at least, but it will be choppy and not as high quality as before for the dollar strength. Our view in terms of our model estimates, the politics or political uncertainty typically lends credence to about 10 cents sort of appreciation to the ringgit that we've seen now. But the rest is actually a function of the dollar declines. Actually, by right, it should actually see a correction of about 30 cents. So the level from about a high of about 475 cents to level of about 449, 450 now is a function of the political uncertainty to some extent as well. And it lends credence to what Anand mentioned, the equity flows back in, the equity resurgence back last week helped it in some ways. But we still have not seen that dollar declines back by about 30 cents. By right, it should be about 330, 335 if the dollar moves fully priced in a dollar weakness So we still have some ways to go to that 330 levels or 320 levels, 420 levels, 430 to 430 levels that we want to see. So we think that the 480 that we had before was a function of considered concerns about political uncertainty being exacerbated, which have been removed. So current move towards 450, 449 will continue in our view, but actually the sustainability below 450, I think it's a bit questionable because there are a few things that we're going to note because of first of all, the budget. There's also concerns about how the parliament proceedings would pan out, and also the cabinet lineup, and also how the budget announcements would be made going forward as well. So those are still considerable issues to take note of on the ringgit front. But I think ringgit on the fundamentals wise, trade surplus tailwinds may possibly help to support ringgit. In fact, in general, before I end, I just want to say on Malaysia's front, we have turned slightly bullish, slightly on the upside for ringgit into 2023. If things sort of materialize, possibly removing some of the political uncertainties further, and with dollar weakness coming out earlier, you should see dollar ringgit actually falling faster towards the 420 levels that we are expecting for end of next year. Suhaimi.
Thanks, Andy. And that's it for this morning.
As always, get specific advice from your trading rep and check out Market Insight on the Maybank Trade app. I'm Noel Lim on ASEAN Speaks by Maybank.